All right, we're going to go ahead and kick this thing off here. I'm Jake Alexander. Welcome everybody to our 2025 tax updates presentation. I'm joined by my good friend Adam. Adam, how you doing today over there?
Fantastic.
Awesome. Thanks for being here. Also, thank you to all of you for joining us. We really appreciate you taking some time out of your day to come learn about something near and dear to our hearts, which is taxes, tax law, tax policy, and updates and all that kind of stuff. So we're going to do our best to bring you a lot of information in a short period of time. And with all that being said, we're going to jump right into it. So in true accountant fashion, I like to be a little organized. I like to set clear expectations of what we got going on today. And so put together a little agenda just so everybody knows what to expect. Start with an introduction of me and Adam. If you're on this webinar, you probably already know who I am, which is great, but we're going to let Adam take a few minutes and introduce himself here in just a few moments, as well as let me do an introduction to us and our company. So quick introductions. At the end of the day, this presentation is not about us, but I always think it's nice that we're not some perfect strangers up here talking to you for the next hour. So quick introductions is how we'll get started. Then we're going to get into some of the meat of it. We're going to talk about what happened, right? What is all the fuss about? What is going on? What are all these changes to the tax world that we need to know about from business side, individual side, and all that kind of stuff? So we're going to spend just a few minutes, not too much, but we're going to spend a few minutes talking about the history, right? All of this stuff started back in 2017 when the Tax Cuts and Jobs Act came out. That's where a lot of these changes to the tax code actually originated from. Then a lot of them have been changed, revised, mixed around, flipped upside down, all kinds of different stuff by this one big beautiful bill act that went into effect in 2025. So we're going to spend just a few minutes talking about what happened, how did we get here. From there, we're going to go into specifics. All right, we're going to talk about on the business side. So if you're a business owner, a lot of the provisions that are in this one big beautiful bill act are going to affect you one way or another. We'll also talk about how it affects you on the individual side. And then we'll spend a few minutes diving into the overall financial picture, because whether or not you're working with a financial planner or a tax advisor already, this stuff is going to affect you one way or another. So we want to just make sure you understand how it all fits together. And then last but certainly not least, Q&A. So we do want to have questions. We do want to interact with you. I want to take just a second and explain the format of how this works. If you've already realized it, then that's great. If not, this is the webinar version of Zoom. So it's not like a regular Zoom meeting where everybody can come off a mute and talk at the same time. If that did happen, things could quickly go off of the rails. In respect of everyone's time, we want to make sure everyone gets plenty of value out of this. And the way that we manage it is with the Q&A box that's down at the bottom. And so if you look, there's a chat box that's just like a normal Zoom, but if you click on there, it's going to tell you that the chat is disabled. The way you interact with us throughout today's program is by the Q&A box. So if you go to the little menu that's on the bottom there, you probably have to go all the way to the right to the little three dots where it says more, and then there's a Q&A box. I recommend everyone bringing it up, and we want you to fire your questions in there as they come up. We've also got plenty of time at the end, so we'll make sure we cover everything, but depending on what it is, we may or may not answer that as we go. I'd also like to, just so we A, know everyone knows how to use it, B, I always like to see kind of some of who we have on the webinar today. So let us know you know how to use it. Go down to that Q&A box and just type like your first name and the city that you're joining us from. I always find that pretty interesting too. So that Q&A box is how you interact with us. We got plenty of time at the end for questions, but if something comes up and it's pertinent to what we're talking about right now, we may or may not answer it one way or another. We'll get to it by the end. And there we go. A couple people from Clearwater. That's awesome. Julie from Tarpon Springs. We got Millie from Dunedin, Tampa. Awesome. South Pasadena. A lot of Florida people. I love it. So, all right, that's our overview. That's what we're gonna cover today. We're gonna start off one of my favorite parts of today's presentation. Adam, take a few minutes. Tell us about yourself.
Sure, yeah. So Adam Taylor, the CEO and founder of Taylor Financial. So looking at the screen, yeah, so I've been in the industry since 2011. So goodness, almost 14 years now. But before that, I was in the restaurant industry. So I became a sommelier, so I can geek out and talk wine if you want to go that direction back in 2006. And then my family and I moved to Tampa in 2009 when I became the managing partner of Capital Grill. Left that in 2011. And then in 2018, I started Taylor Financial. It was almost a Jerry Maguire moment when I left the previous company. Who's coming with me? It was just me, and now obviously we have a lot more people. We've been very fortunate to win the Seminole 100 Award. I am born and raised Tallahassee, Florida State alum, and Seminole 100 recognizes the fastest growing businesses owned by a Florida State alum in the US, and we won that 6 years in a row. And then we've been nominated a few times through the Tampa Bay Chamber and some other local businesses just for the work that we're doing. And I'm also a student of the business, wherever it is, all these fun letters and all these fun degrees. I have another one coming in hopefully 2 months. But again, always sharpening the saw from education. And then the team has been very nice to get me featured in all these cool publications underneath there. So yeah, that's me. Just really glad to be here, and I appreciate the invite, Jake.
Yeah. No, Adam, thank you so much for being here. It's absolutely a pleasure. Kind of like I said, if you're on this webinar, you probably know who I am and a little bit about our business, but just to make sure, Jake Alexander from Action Accounting. We started the business back in 2016. We've grown to a team of 10 people. And at this point, we have four main departments in our business. We have a bookkeeping department where all they do is create financial statements for business owners, help them understand how to read their P&L and their balance sheet and their cash flow statements so they can make better, more informed business decisions in running their business. We have a tax preparation department where all we do there is compile and file timely and accurate tax returns for businesses themselves and for the respective owners of the businesses. We have a tax planning department, which is where I spend a majority of my time. And quite frankly, is what all of you that are joining us are doing right now. This is where we put proactive strategies in place to proactively save people as much money on taxes as possible. And it starts with conversations like this, being aware of things before the end of the year. Now is the perfect time to put some of these strategies in place. And that's absolutely what we love to do in the tax planning department. And then last but certainly not least, we have our business consulting department, which is doing very well, is our newest department. That's where we help business owners put systems and processes in place to turn their business into the dream business that they started it for in the first place. If you need to get a hold of us, you always can from our website, which is actionaccountingusa.com, and all the big social media channels. So that's just a little bit about me and Adam. Not to go backwards, but just to reiterate, if you are joining us now and you have a question, please pop it in the Q&A box. I see somebody's got their hand up in there. We don't necessarily have a way to take you off mute and let you ask a question, but if you do have it, pop it in the Q&A box. We'd be happy to address it. All right, so we're gonna pop right into the actual content here. We're gonna talk about what happened, right? Like, why are we all here in the first place? What are we actually talking about? What is the big deal, right? Maybe some of you do or don't understand it. So just a little bit of background. The Tax Cuts and Jobs Act, this was passed back in 2017, and this was a major, big change to the tax code. It did a lot of things to the tax code that hadn't been done or changed in a long time. It lowered the tax brackets to where now the highest tax bracket's 37%. Prior to 2017, they were like 40% plus. It doubled the standard deduction and got rid of exemptions, which it's a little bit more of a technical term, but for most individual taxpayers, what that means is they got a higher standard deduction than they previously did. It introduced QBI, which is a qualified business income deduction, just something Adam and I go back and forth on quite frequently here, talking about in the office. But that was an amazing 20% deductions that was offered to business owners that automatically reduced the amount of money you had to pay taxes on. So that was pretty cool. It changed bonus depreciation to 100%. So once that happened, then if you bought a vehicle or an asset for your business, you could write off up to 100% of it in the year that you purchased it. And then change the corporate tax return, corporate tax rate percentage from 35% to 21%. So there was a lot of changes here in this Tax Cut and Jobs Act back in 17. This was considered like major tax reform. Prior to this was the biggest change to the tax code in like 30 plus years, right? And a lot of those provisions were set to expire in 2025. And so fast forward, here we are in 2025. Now we have the One Big Beautiful Bill Act, which is officially passed and in Congress. And in place. And so what it does is it revises or replaces a lot of the elements that were set in motion in 2017 in the Tax Cuts and Jobs Act. And so once again, this is considered sweeping tax reform. So this is from the IRS, from the government. This is considered like a big deal. A lot of these changes are bigger changes that have been made in the past 30 years. And so it impacts everybody. You're probably asking yourself out there, well, like, is this actually going to make a difference to me? Well, if you're getting close to retirement, absolutely. There's some benefits in there for seniors that are newer, that are really great things to be aware of. For families, there's some changes to the child tax credit, to the amounts there. If you're an employee, there's some really big changes, which we'll get into here in a few moments. I think one that a lot of people are very familiar with is like the no tax on tips, no taxes on overtime. We're going to break that down and we're going to jump into that here in just a few moments. And then uh, most impacted, I would say, is business owners, because as a business owner, not only do you need to be aware of the changes of how it's going to affect you personally, but you also have employees who, if these changes affect them, they're going to be coming to you, they're going to be asking, they're going to be needing guidance along the way too. And so it impacts everybody. One of the things I like to point out, because in the tax business, we love creativity, right? We love gray area. That's sort of where we earn our living or earn our keep, if you will. A lot of times when these things come out, kind of like the no tax on tips or the no tax on overtime, some of the immediate questions we get are, hey, does that mean I can just reclassify my salary as tips and then I don't have to pay taxes on it? The answer is probably no, right? But I like to use that as an example of creativity of some of the questions we get, and then hit on this last point right here. So, to me, one of the biggest parts of the Big Beautiful Bill Act is they expanded the IRS funding. They put aside $80 billion to modernize the tools, especially in two areas. One of them is AI auditing, so artificial intelligence auditing. Not sure what type of business you're in out there, but if you've messed around with ChatGPT and all the other different artificial intelligence softwares, they will do some amazing things. The IRS is specifically putting artificial intelligence auditing tools in place to focus on high income earners, which the IRS defines as taxpayers earning over $1 million per year, and small business owners. And so I say all that as somewhat of a disclaimer, where we love the creativity, we love the gray area, but part of this big beautiful bill is to make the IRS a little more efficient on their end, which is a long time coming, in my opinion. And so we jump into the business side. And two, if you are joining us here, make sure you use that Q&A box, type in if you have a question or anything like that along the way. We would love to hear feedback from you as much as possible and pop those questions in there. So we'll jump right into the business side. One of the big ones is bonus depreciation. This is back to 100%. This was scheduled to be at 40% in 2025, 20% in 2026, and then go away to sunset in 2027 and moving forward. So they changed that back to 100%, which, Adam, that's huge. That means business owners can buy vehicles, assets, all sorts of different equipment and those sort of things in their business, and they can depreciate up to 100% of the cost in the first year. So that's a huge one. Another one's R&D expensing is back to 100%. So for business owners out there that have costs that are related to research and development, one of them that comes to mind is like software companies automatically qualify for R&D credits. The IRS made a change several years ago to that, where business owners would have to take those expenses and spread them out over 5 years. Now you can take up to 100% in the year that you incur the expenses, so that's huge. Another one is changes to the qualified business income deduction. You heard me talking about that just a few moments ago. They made changes on there where that's going to start to phase out between the 400,000 and 500,000 income threshold. And that's really important when it comes into things like retirement plan incentives. So one of the things on the big beautiful bill was retirement plan incentives were preserved. There was a lot of rumors or back and forth that some of those changes or some of those limits of how much you could put into retirement plans were going to change, but those are actually preserved. And so to kind of put this all together and put it in context, this QBI deduction is huge right here, especially for somebody who's roughly in, say, like a $550,000 income threshold for the year. We might need to look at setting up a retirement plan if you don't have one already. We can contribute a number into that retirement plan to help lower the taxable income. Maybe we had some R&D expenses in our business we didn't realize throughout the year that qualify, or maybe we need to look at buying some new assets or a new vehicle by the end of the year to bring that income below the threshold. Then you're going to automatically qualify for that 20% right there. And so that's just a little bit on the business side there. Adam, why don't you tell us what we got going on the individual side?
Yeah, sure. Can you go back one slide? I want to touch base on the last part. So the retirement plans, I can't stress enough how important a solo 401k is. If you're a business owner, you have the opportunity for you and your spouse to put up to $70,000 each into a tax deductible account. Or we do a lot of what is called mega backdoor Roth conversions, where if you want to pay taxes now and have it grow tax free, there's another way to get 140 plus $1,000 into a Roth asset with some of these new retirement plans and all the stuff that happened from Secure Act 2.0. So highly encourage you to look into that if you're a business owner, or if you even have a side gig. There's opportunities to contribute not only to your employer, maybe W-2 401k, but even have your own outside and contribute to that too. So we can help there. Obviously, in Taylor Financial, I don't know if I mentioned this, but comprehensive financial planning firm. We have strategic alliances like Jake, and we have Chase, who is right behind me. He's an estate attorney, so he helps with wills and trusts. And then Taylor Financial, we do a lot of the wealth management. We do the insurance planning of life, disability, long-term care. And then we do a lot of financial planning. We use some really unique software to help there too. But again, just wanted to touch on the retirement plan briefly. But let's go to that. Let's go to the individual side.
Let's do it. I love that. I'm glad you brought that up. And that kind of just shows the power, too, of having a good team in place, of working with a number of professionals who are all help pushing your goals in the right direction. So, yeah, that's awesome. Thank you for mentioning that.
Yeah, so no tax on tips. So this is new. So workers can now exclude up to 25,000 in tips for those that work in food and beverage, maybe beauty services. It applies to cash and credit card tips, not just reported via W-2. You do have to report the tip. So if you take cash in pocket, it's hard to exclude that from a deduction standpoint. But what's unique about this is that whenever individuals are filling out their W-4, they may want to change those withholding needs because they could potentially take more home on a weekly, monthly, whatever they get paid basis versus having to wait until they actually file their returns. Now there is a phase out, which means you may not be eligible. It starts at 150,000 adjusted gross income for an individual, and then 300,000 for married filed jointly. However, even if you're above that 300,000, it does reduce $100 for each 1,000 that you're above that amount. The point there that you could still make upwards of almost $400,000 as an individual and still have some type of deduction, or up to 550,000 joint household income and still potentially have a deduction. So a great opportunity for those in the hospitality or service-based industry. No tax on overtime. So very similar to the phase out, it's actually exactly the same. And then overtime earnings up to 12,500 individual or 25,000 married filed jointly are now tax exempt. So applies only the true hourly based overtime, no bonuses or commissions. So it's an opportunity to maybe go to your employer and see if there's an opportunity for them to restructure some of their compensation to include more OT hours versus bonuses. That also could be a recruiting technique for them. And so again, it's if you do have overtime, if you are hourly, it's a great opportunity to reduce some of your taxable income. Personal car interest, first time ever. I love this. A lot of you know I'm a car guy, but personal auto loan interest is now deductible up to $10,000, even if you do not itemize. So itemized versus standard deduction, which we'll get to. But eligible vehicles, it's cars, vans, light trucks, motorcycles, and the vehicle must have a final assembly in the US. So does it have to be a Ford, a Chevy, a Dodge? No. If there's a manufacturer that finishes the assembly of the vehicle in the US, and if they have a VIN number of, I think it's 1, 4, and 5, I'll have to check that, they could actually be part of this. So RVs, boats, and leased vehicles are excluded. There are also phase outs here. So 100,000 is for an individual. It does phase out completely above 150,000 if you file single. If you file jointly, it starts at a 200,000 phase out, and anything above 250,000 of modified adjusted gross income unfortunately, you would be phased out completely. So if you're below that amount, or you think you will be, you can potentially refinance your loan and still qualify. So let's say, because it starts now, let's say you bought a vehicle 2, 3 years ago and you refinance it, as long as the new loan doesn't exceed the balance of the original first lien, that would actually be eligible. Again, lease vehicles are not eligible, and loan must be for personal use, not for business deduction purposes. That's a whole other thing. So great opportunity, especially if you're below that amount.
Yeah, I love that you brought that up there.
Yeah, so this is probably one of the biggest ones, especially maybe not in Florida, but in states that have high income tax. Jake and I are talking about like California. I mean, don't they pay stupid amount of state income tax?
Absolutely.
So it's going from 10,000 to 40,000. So what SALT stands for is state and local tax, and that's the deduction. So going from 10 to 40,000, depending on if you file as a standard deduction or if you itemize. So a lot of people say, well, what's included if I itemize? Well, state and local taxes, so your property taxes on your real estate. And Jake, it's also if you have another home, so it could potentially be your main primary is secondary as long as it's not a rental home. Is that correct?
Secondary residence could qualify as well, as long as it's not a rental property.
So that's one itemized opportunity. Medical and dental expenses. So anything that's out of pocket. So doctor, dental bills, prescription, insurance premiums, long-term care expenses, those can add up. Mortgage interest. So interest up to 750,000 of debt. So if you paid any points on a mortgage, that can be added to itemized. If you have a home equity line or a home equity loan, so a HELOC or a loan, you can deduct up to 100,000 of that as part of your itemized deduction. Charitable contributions. Me personally, I love giving back. I have a large philanthropic need that I want to be able to contribute. Well, those charitable contributions can help with some itemized deduction. So cash donations, even non-cash donations. If you're doing volunteer work, you can actually even deduct the mileage or out-of-pocket expenses related to that work. Casualty and theft losses. So if there's any, like with a hurricane last year, or if there's losses that you weren't made whole due to the insurance, these are all items that really add up in the itemized category that goes from that 10,000 limit up to 40,000. So a big deal, especially in state income tax areas, but even in Florida, I think it's going to help quite a bit.
Yeah, those are going to be huge. Not to interrupt you, Adam, but just to take a few minutes before the end of the year and maybe make a couple of different decisions on if you're going to prepay the taxes for on a property for next year or all sorts of different things. It just to me reiterates the need for proactive planning. Let's get ahead of this stuff, kind of understand what's out there. So and two, we had a couple other people join, so just throwing it out there. If you do have any questions, please throw them in the Q&A box. We do want to interact with you. If you try to hit the chat box, it'll tell you that the chat is disabled. It's not because we don't want to hear from you. You just got to go hit those little three dots on the right, go to Q&A, and type something in there. So if anybody's got any questions, feel free to type those in too.
Yeah, so as far as before we get the child tax credit, as far as the SALT increase, really talk with your team, your accountant, your planner to evaluate if you should actually do itemized deductions or the standard deduction. Standard deduction for a married household is now 31,500, but again, having additional almost $10,000 of reducing income is quite a bit. So. The child tax credit. So I've got three little ones, right? And so it increased to $2,200 per child under the age of 17. The phase outs do begin at 200,000 individual and 400,000 for married filing jointly. So this is helpful for a lot of our clients when we do what is called tax loss harvesting, when we sell winners and losers to help offset any taxes for individual stocks. Roth conversion timing. So if you're able to really help reduce some of your taxable income, great opportunity for Roth conversions, and just for overall business owners to help remain under certain income thresholds for other areas. EV credits, $7,500 is gone. So previously, you had certain manufacturers had a limit of what they could do for EV credit, and it was 7,500 if it was below a certain purchase price. If it was above a certain purchase price, you could do a lease, and they could take that 7,500 into the actual payment itself. But that's all gone, no longer available. So it applies both to new and previously qualified EV models. So if you think about for some planning opportunity, some states still may offer these credits or rebates. So check with some state programs, review leases and purchases. Some EV dealers still may offer these incentives kind of via some commercial credit loopholes that we've seen. But what I think it's going to do, it's going to reduce the urgency for EV buyers and vehicles. It may affect resale value. So I got my first EV vehicle a little over a year ago. I love it. Not sure I'll get another one, but I do think a lot of EV vehicle values will be going down. So it might be an opportunity to think about your next car purchase, especially if you are under that income threshold and you look at that auto interest on some of the American made vehicles. Overall financial picture of Trump accounts for children. We get this question all the time. First off, it doesn't start until January 1st of 2026. So don't call us and say, hey, let's start this today. I can't do anything there, but the Trump account is a type of traditional IRA established for newborn kids. So they have to be born in 2025. And what happens is the government will fund $1,000 for each child born in 2025 to 2028. So as of now, it's really only those 4 years, 25, 6, 7, and 8. Parents, family, and others can contribute up to $5,000 annually after tax. So they cannot take a tax deduction. So it'd be after tax going into a traditional IRA. Eligible investments, mutual funds, ETFs, and this is interesting, with expenses less than 0.1%. So 0.1%. So it's a great way to get into like an index or some type of ETF that's a very, very low cost that could be a drag on the overall performance long term. No allowable distributions prior to age 18. So again, it's more of an IRA long term. Also, check with employers because they may fund up to $2,500 annually into an account for the employee or for the child of the employee. And it's not included in the employee's gross income. So I thought that's pretty unique. I do think there's going to be a tremendous amount of changes here. I personally don't like that if you put money into it, it's not deductible. If you're a business owner, maybe think about adding kids to the payroll to do other fun Roth and 529 plans and other fun stuff there. But I think come next year, we may have to reevaluate 529 plans, UPMAs, even some other things too. So stay tuned. There's a lot of gray area there, but the minimum it doesn't start until January of 2026. 529 plan. So I talk about this a lot too. So Secure Act 2.0 a couple years ago made some changes that allowed you to have any unused 529 plan balances potentially rolled into a Roth IRA for the beneficiary of that 529 plan. Now there's a limit on how much you can put in per year of the 7,000 roughly now, and a maximum of 35,000 lifetime can go into that Roth IRA with unused 529 plan funds. And the account has to be open for 15 years. So again, some interesting things there. But what the new bill did, it added a lot more flexibility to using 529 plans before college. So kindergarten through 12 currently, or I should say a month ago, you could use up to $10,000 a year for tuition. Well, now for 2025, you can use up to $10,000 a year for tuition, room, board, books, other things that you may incur costs from, let's say, a private school that's not just tuition. Next year, that 10,000 annual limit goes up to 20,000 per kid. So if you have a lot of money in a 529 plan, you're not sure if little Johnny or little Susie is going to go to college, or you just want to cash flow that, or you just have excess funds, you may want to think about using up to 10 to 20,000 for your K through 12 tuition, even student loan repayment or other ancillary costs that could come with it. So it's a great way for multi-generational planning. We're setting up more dynasty 529 plans than anything, which goes into how do I get to the next generation? So grandparent owned 529 plans, or you own for your kids' kids. So really some unique changes there that make 529 plans much more flexible. How am I doing so far, Jake?
You're doing amazing. I love the kind of the comparison of those two. So from your perspective, from just like an overall financial picture, now when people are planning for their kids' college, they've got this whole Trump account that comes into a play, or maybe they do the 529, maybe they don't, maybe they split their contributions. Is that those kind of scenarios? Is that what you're going to be able to help people walk through there?
Yeah, I think the Trump accounts, I think it'll get a lot of initial traction, but long term, I think it's challenging to be able to keep track of after tax contributions versus what they put in. So I don't know long term if that Trump account will really be a sticking point or asset for kids. I think with all the flexibility of 529 plans, I think with the fact that there's no really limit to amount you could put into it. And gifting rules are now up to 20,000 per person without filing any type of gift tax. You could upfront load these plans quite a bit of money. And there's great benefits whether you live in Florida or a state income tax on these 529 plans. A whole other conversation of where I think the market's going from US to international, just kind of a market standpoint. But I think it's a great opportunity to put money into 529 plans and almost put too much into it, because if you don't use it for um, K through 12, you may use it for college or potentially even roll it into a Roth IRA for the little one. So I love 529 plans, the flexibility and all that, more so than even Florida prepaid or even UPMAs and even Trump accounts at this point.
Nice. I love it. You asked how you're doing. In my opinion, you're doing fantastic because this stuff is invigorating to me. Like I love listening to it. I love learning more and more about it too. So thanks to
I'm
everyone that
sure.
joined us. If you do have questions, pop them in that Q&A box. We'll make sure we answer them, or you can always hold them to the end there too. Adam, tell us a little bit about estate plan exemptions.
Yeah, so before July 4th, when this went into place, and it was going to sunset in this year from the 2017 Tax Cut and Jobs Act, and it was a big planning, which meant, prior to this, it was going to sunset to 7 million per person or 14 million total, which means if you and your spouse passed away and you had an asset or you had a net worth above $14 million, you're going to have to pay 40% in estate tax to 330 million people you've never met before, right? So a lot of clients were really worried about it, the potential sunset. And then if they had an estate above that amount where they're having to pay so much of their assets to tax, you just don't need it. So it went from before a month ago to about 14 million each. It went to 15 million each, or 30 million for married couples. It also has an automatic inflation adjustment, so that 30 million for married couples will go up. And it only kicks in when the second spouse passes away. So let's say I'm married, I pass away, my wife is not having to deal with any type of estate tax above that 30 million mark. But when she passes away, if the estate is above $30 million, there still is that 40% estate tax. So, Chase, in the office, we do a lot of irrevocable trust planning to try to take some of these assets out of your estate. As I mentioned before, the annual gift tax exclusion is going to rise to 19,000 a year now, up to 20,000 for next year. So it's a great way to reduce some of your total net worth and your assets by getting it out of your name into someone else's. So a lot of changes there, and it may change how some estate planning attorneys are implementing irrevocable trust, and then more focus on revocable trust for privacy and distribution matters. So.
I love it. To me, it just says like there's so many options out there.
Yeah, so senior tax breaks. So this is So right now, the standard deduction, they get the additional standard deduction, but they also add another separate deduction of 6,000 per taxpayer above age 65. So if you're 65 or older, if you have parents above 65, even if they don't itemize, there is an enhanced standard deduction for those individuals, which could help quite a bit. So we have a lot of clients above age 65 that have what is called required minimum distributions from their investment accounts. And this is really going to help reduce the income threshold for them to do qualified charitable distributions, which helps just reduce some of their overall taxes. So again, it may help simplify some of their planning when it comes to standard deduction. So above 65, great conversation to have with yourself, your parents, whoever it may be. 5250 employer student loan benefits. Yeah, so employers can now contribute up to that amount towards student loans, tax-free to both the employee and the employer. So the big thing there is that go talk to your employer and say, hey, if you do have any
You
type
need
of
to kick
student
some money
loan.
in towards my student loan payments,
But
is what
hey,
that
listen,
conversation
you
sounds
know
like,
you
huh?
you contribute up to $5,000+ and it's tax free, to my student loans. And so I think what will happen is a lot of employers will use this again as a recruiting and retention tool. Because I think once they adopt this, it'll help with a lot of those individuals that are coming out of maybe college with a tremendous amount of student loan debt.
Yeah, that's awesome. Just to touch on that for a sec, I think it's cool all of the employer offered benefits that are changing, So this student loan assistance, the no tax on overtime, no tax on tips, it's almost like there's a little bit of work to be done or to be required, from business owners in those industries who cater to them to be able to just explain it to their employees.
Yep, love it. Yeah, so we have clients that are 4 years old, and we have clients that are, I think we have like an 88-year-old client. So, and there's planning, as we've kind of alluded to and talked about, there's so much planning you could do from the beginning to the end. So it's unique and it's ever changing. So it's important that you connect with your team and say, hey, how does this new bill really affect my financial plan or my parents or my kids? Because there's a lot of changes as you mentioned earlier, Jake. It's been fun. It's either you're either green and growing or you're ripe and rotting. And what we love here is that we're just constantly learning this, constantly sharing it, and having that creating that just unconscious competency because we reiterate it so many times. We can really kind of navigate with our clients of the best direction to go.
Yeah, I love what you said there too. And from our perspective, we're constantly learning this stuff as we go too, right? It's between now and the end of the year when we really have time to make these changes. But the actual bill itself is 800 plus pages of what I consider, invigorating material. I'm not reading that stuff before I go to bed. Like it gets me fired up. But I love talking about it and jumping into it. And sort of in conclusion, a little bit here, we'll start to bring this thing in for a landing. Thank you so much, Adam, for everything there. Not to repeat myself, but if you do have any questions or anything on your personal scenario or anything you just wanted to throw out or emotional outbursts or tell us how amazing of a job we did, feel free to throw that in the Q&A. This little graph right here is, to me, is pretty interesting, right? There's a lot of changes out there. There's a lot of different things happening. If you start from the bottom, if you're a W-2 employee making under 150K, it's like a one level fire alarm alert, of changes and impact and that stuff. And you might only need a little bit of planning required, right? If you have a family and you have dependents, we're still kind of one level here, but you're going to need a little bit of planning just to understand real estate investors. When we talk about that bonus depreciation and how those have changed and everything, there's a lot of really cool things that are going to be available for them moving forward. When we kind of just move up the spectrum here, where this is really going to affect people the most, in my opinion, are people who own small businesses and are earning high incomes from those businesses. You want to do as much planning as possible. You want to reach out. You want to talk to as many people as possible and really just go from there. And so, in moving forward, planning is more important than ever. You need a tax plan both on the tax side and on the financial planning side. You want to start now, not wait till the end of the year, and you want to book a call. So if you're one of Adam's clients, you know how to get a hold of him. If you're one of our clients here, you know how to get a hold of us. And so you can always do that from our websites, which is actionaccountingusa.com or taylorfinancial.com. We're going to go ahead and bring this thing in here for a landing and open it up for questions from here. So, Adam, I can't thank you enough for everything. I would tell everyone who's still here, if you do have any questions, to let us know. Pop those in the Q&A and we'll make sure we answer them. We got one from Ron here. Any changes to taxes on Social Security? Adam, what's your thoughts on that one?
Yeah, I mean, so for Social Security, depending on your income level, 85% of it is going to be taxed. So as of now, Ron, there's no changes to Social Security. What I will tell you that there are some strategies here to help reduce some of your taxable income. So if you're able to reduce your taxable income to a certain degree, I don't have my cheat sheet in front of me. Let's see. If you're able to reduce your taxable income under a certain amount, you could reduce your taxes on your Social Security.
And
Uh,
that was one of the big rumors was this bill was going to promote no tax on Social Security. That's not something that officially made it into the bill as of right now. So,
yeah.
and anyone else out there, if you have any questions, Chris is asking the child IRAs, the Trump IRAs, is that only for kids being born 2025 and after?
Yes.
So born 2024 and prior does not qualify.
Unfortunately.
Have you done, Adam, any sort, not to put you on the spot or anything like that, but I know you and your graphs, which I love. Have you ever done one, that says if you get this account in 2025 and then continue to put $1,000 in it over the next 18 years, what it could potentially turn into with average market returns and all that sort of stuff?
We do it all the time, usually real time. And if you want to geek out, if you type TVM calculator, time value money calculator, there's an FN calculator that we use all the time, and it's extremely valuable. So I don't have a graph readily available, but it's neat to see what that looks like, especially.
Yeah, that's awesome. Someone else said on the Trump account, I thought they would have to be born from 25 to 28 for the credit, but I thought childcare can be less than 8 years old as of 2026 and they qualify.
So my understanding that was before the final revision. So that was what was discussed over a month ago. But our understanding from everything we read that the child has to be born in 2025 to 2026.
And there is a lot of stuff out there. This is somewhat of a moving target for us. So like I said, between now and the end of the year is when it's very important to nail everything down. So if you have specific questions on your specific scenario, we'd encourage you to book an appointment or come to the office. We'd love to talk to you about it. As of now, we're doing our best to convey as much information as we have. So if anybody else has any questions, feel free to type them in there. I always jokingly say, if nobody has any questions, that's the ultimate compliment to you and I, Adam. That means we did such a good job on conveying all the information that nobody could possibly have any questions from here. And everyone's going to go home and rewatch it 9 or 10 times to become an expert themselves.
I love it.
Maybe not on that last part, but if you do have any questions, feel free to type them in. Adam and I will hang out for a few more minutes here. And this is one thing. Oh, I always like to throw this up there. This speaks to my heart. I kind of want to get this blown up and put on like a big mural on the wall in the office here. But this is a quote from Judge Billings, learned hand, who he was a U.S. Court of Appeals judge back in 1934. This is an opinion, official court opinion that still to this day has never been overruled in a court of law. And he said, anyone may so arrange his affairs so that his taxes shall be as low as possible. He's not bound to choose the pattern which best pays the treasury. There's not even a patriotic duty to increase one's taxes. And so I know I'm kind of preaching to the choir here because everyone that's listening to us joined a webinar to learn how to save money on taxes. But I just love this quote because it conveys to the public that tax planning, proper tax planning and preparation is okay. Like there's all this stuff out there that's written in the Internal Revenue Code, and to utilize it to its full advantage is absolutely okay by the IRS and by the US government. And so another one, we do have another question from Anonymous says, how will these changes specifically affect real estate investors? So the big one there, if you have a specific situation, we could dive into it. But what comes to mind is cost segregation studies. So with a bonus depreciation prior to this bill being on the phase out period, it was only up to 40% this year of assets that you could depreciate for real estate when you do like a cost segregation study. Then that was scheduled to be at 20% next year and then phase out in 2027. So with the changes that have gone into effect here, it could be up to 100% again for specifically for things done in a cost segregation study when purchasing investment real estate is the main example that comes to mind. So if you have a specific example, we can dive into that. We got a few more minutes, but from an overall perspective, that's what comes to mind.
Yeah, I mean, so there's recent discussion, even I think it was yesterday, where Trump said he was going to get rid of the capital gain tax on real estate. So I don't know how realistic that is because that's $170 billion probably change that could impact not only debt but just overall U.S. economy. But there may be something or further discussion where there's now an elimination of capital gain tax on real estate, including investment properties. A lot of our clients will do what is called a 1031 exchange. So I'm sure a lot of you know this as well. But a 1031 exchange is saying, hey, if I bought a vacation home as a rental for 500 grand and I want to go sell it and it's worth 1.2 million. Well, if I were to sell that, I would have to pay $700,000 in gains. Long-term capital gains is called 15%. So that's $100,000 in gains. That doesn't really feel good. But if you go into a 1031 example and you find a like property, or you go into like a Delaware statute trust, DST, or an UPREIT, some other ones where you don't physically have to hold the real estate, you're more like a pooled investor, there's a way to defer those taxes. So doing a 1031 exchange into a like property is very popular. And then you get a step up of basis that if you die, your beneficiaries now don't have to pay that 700,000 of gains. It's now their basis at 1.2. So if Trump gets rid of the tax on the capital gains of real estate, that's going to change a lot of things, a lot of 1031s, a lot of these DSTs, these UPREITs, all these kind of other strategies. But yeah, so that's one. I know, Jake, I don't remember. I know there's they expanded like the opportunity zones for the bill. I haven't read too much into that. I'm not sure if there's, I don't know if you know anything on that yet, but I know the qualified opportunity zone is now permanent, but I don't remember what that is, all the details at least.
Yeah, I know there was expansion to the legislation. I'm not 100% up on the details yet, but maybe we do a follow-up webinar on opportunity zones here.
So yeah, just to back up with that. So another way to say, hey, if you reinvest your capital gains into a qualified opportunity zone, you would receive a partial step up in basis if retained at least 5 years. So I believe the new bill made that a permanent thing. So, and you get like a 10% basis step up after holding it for 5 years, another 30% if you do another five. So there's some changes there, but that's mostly for kind of that sell of 1031 to another property or something else.
No, this is fantastic. We got a few more minutes here, so if anyone has any other questions, pop them in there. If not, I could give Adam and I another minute or two back in our day, back in our calendar here. We would definitely appreciate it, but I can't tell you how much we appreciate everyone spending a little bit of time with us today. Asking the questions that you did and interacting was amazing. Like I said, we love talking about this stuff, so we could go on and on and on and on and on, but we won't. In respect of everyone's time, we'll get ended here in just a few more minutes. So Adam and I'll stick around for another minute or two if there is any other questions. If not, we'll give you all a few minutes back in your day here as well.
So I'm rereading some of the questions. I just saw that. I was just answering on the fly. I didn't realize they're actually there. But on the Trump account, I thought they
hey,
would have.
I'm doing a lot over here. I'm kind of like a DJ. Like it doesn't look like I'm doing stuff, but I'm fielding questions. I'm, going back and forth. So
Yeah, so on the question on the Trump account, I thought they would have to be born between 25 and 28 for the 1K credit. That is correct. But I thought the child could be less than 8 years old as of 2026 and they qualify. So I should have said, yes, they can get a Trump account. They just won't get the $1,000 free money, if you will, from the government. What we have found is that we would question Why to do that? Due to after-tax contributions, due to not being able to get it into until age 18, maybe limited to the selection of investments due to the 10 basis points fee that is allowed. So yes, you could do that, but the reality is you probably wouldn't want to do that. We would encourage you to do things like 529 plans or UTMAs, UTMAs. Those are just much more valuable. The big value of the Trump accounts is the free money. So if you don't, or if you're not eligible to get that because maybe your kid was born prior, we believe there's other vehicles that we would encourage you to go into, not open up something that may not even be there, right? So a lot of this is permanent change, but in 4 years, this may not be permanent, right? So I would stick with more tried and true things unless they're giving you free money.
And there was a follow up there that said tax deferred growth from 8 to 18.
Yeah, I mean, so you could do that as well through like 529 plans again with the flexibility of moving that into Roth IRAs. UTMAs are great because you get zero tax up to a certain amount, and then you get kitty tax before it goes into parent tax. So there's a lot of good stuff there too.
And
And if you're and if you're a business owner, you can add kids to payroll. We had a client who had a 4-year-old and a 6-year-old, and they're doing marketing, they're doing kind of organization, they're doing like legitimate jobs to where you can pay them, up to the standard deduction of over 15,000 a year. Now, talk to Jake, talk to your accountant to make sure it's all by the books. But if you do that, they then have earned income, and you could do a Roth IRA, you could do a traditional, you could do other fun things, retirement accounts for a kid that's 8 to 18 or 4 or 6, whatever. So there's some other strategies there.
there's a lot of options out there, is what I'm hearing, Adam.
Yeah.
That's great. Got another one says my dad owns properties in a LP, which is a limited partnership, and wanted to add me to help him manage since he's getting older. His accountant told him that would result in capital gains. Is there a way to avoid the capital gains in this instance? It's probably more up my alley than yours. It depends, right? So in a partnership, there's what's called a limited partner, and then there's also general partners. Depending on how you're listed and what your activity is in the partnership, you may or may not be able to avoid those gains. So great question. Kind of the simple answer is it depends. If your current accountant told you that would result in capital gains, then more than likely it would because of the way you're being listed on there and what your activity is in the project. So I think, and if you wanted to have a conversation to dig a little deeper, absolutely we could. But
Yeah, I mean, so if her dad gifts or transfers the ownership from an LP to her, I'm almost positive, right? It would trigger capital gains, especially if it's appreciated. But if he gifts, no, that would still do it. So the workaround there is why not add her as like a manager or even a general partner without changing ownership? And then that would avoid the taxable event, right?
That's exactly where I was going. So if there's an actual transfer, if you're added to ownership on the tax return, then that more than likely we would have to dig in and kind of go through the details, would trigger like a taxable event. But there's nothing saying you can't help out in the business without actually being a listed owner to have to go on the tax return. So that's a great question.
Yeah, and remember too that dad will get a step up in basis. So when he passes away, and let's say she inherits that property, there's no taxable event there. So, and with if he wanted to, he can gift was it 19,000 a year now and 20,000 next year per year to her without having to file a gift tax return, each and every year. So there's ways around that. I just don't know. I would just help manage and not change ownership until he passes away, and then there's no taxes on either side.
And this would be a good one for like an overall estate planning perspective to just kind of understand. So it says properties, plural. Not sure how many that actually means,
Got
but depending on the size of it, that could be something where we sit down and help you draw up an overall plan for. So great question. I love that. Hopefully I give you some context there. If anybody else has questions, type them into the chat. If not, we got 4 or 5 minutes left on here. Adam can always do a magic trick for us. I could tell some jokes, but those probably aren't going to go over too well. So if nobody else has any questions, we'll cut this thing off. We'll go for another minute or two. If anybody does have any questions, put them in the chat. If not, we'll give you a couple minutes back in your day. Once again, Adam, appreciate it so much. Everyone that tuned in, everyone who's watching this afterwards, thank you so much too. If nobody else has got any other questions, then we'll end this thing up. So thanks, Adam. Thanks, everybody else out there. We'll talk to y'all soon.
See ya.